Hello and welcome to Your Money, Their Hands. And this week we're back at Fidelity International to talk to the Director of Asset Allocation, Trevor Greetham. Trevor, your famous investment clock, it's time to move on, but before we look at it in detail, you've been conducting research over returns for the past 10 years. What have you concluded and how has it affected your thinking going forward into 2010?
Yeah. Well, obviously it's been a very disappointing decade for investors in equities. People who were buying stocks back in the heady days of the dot-com bubble are sitting on negative nominal returns and negative real returns over a 10-year period. And people have said if you own shares, the longer you own them, the more likely it is you make money. So obviously lots of disappointment. We look back at other periods where shares had gone down in real terms over 10 years. And in the last 100 years, it's the Great Depression, it's the two world wars, and it's the inflationary 1970s. Those are the only times you would have lost money in real terms in shares over 10 years. And consistently, if you looked at the following 10 years, you got more than 10% a year in real terms from those investments from that starting point. So the first point is, don't be put off shares altogether by the fact they've done badly. That means you've got some attractive valuations going forwards.
2009, though, was a fantastic year, surprised everybody, presumably. Can that carry on, though, or do you see in these periods of good decades, a 12-month period where it just doesn't perform as well?
Well, clearly there's always volatility in the short term, and you can't predict with any kind of certainty, as we've all learnt the last few years, what shares will do over short time periods. But the investment clock approach means that we're pretty optimistic still on shares, on property and on commodities. And as you know, we look at growth and we look at inflation, and we're seeing some very strong growth lead indicators. In fact, they're the strongest they've been in about 30 years. You've got to go back to 1975 to see this kind of level of positive forward-looking indicators. And this has been a bigger stock market recovery than 1975 for some markets.
So looking at the asset allocation now, where do you favour? What's the Fidelity International position? Where are you looking
Well, for my funds that I manage, so for example the multi-asset strategic fund in the UK, we're overweight commodities, we're overweight equities with focus on emerging markets and Asia. We like industrials and technology and resources and some financials, and we're also overweight property. So basically what we're doing is we're taking money away from cash and particularly away from government bonds, and we're redirecting it towards the areas where we think in a strong recovery like this you should be making some good returns. I think there is a kind of question mark about inflation. It's picking up, mainly because of energy prices, but there is lots and lots of spare capacity, lots of unemployment, and therefore it's really hard to get inflation going. So it seems like, although we've got some near-term bumps along the way, it seems like interest rates will stay low, profits are recovering, and we're still optimistic.
You mentioned Asia there. We've had fantastic trade output figures from India. China continues to astound. Is it really realistic to expect them now to be the engine of growth, taking over from America?
I don't think it is realistic to expect them to be the engine of growth immediately. Clearly, the growth rates are so big in the region that they are contributing a lot to global growth. There's no doubt about that. But you do need America as well, and you need the rest of the world to be growing, I think, for some kind of global strength. But you're seeing it. The retail sales have been picking up quite rapidly in the US. We had some great numbers for the UK over Christmas that have surprised people. And industry is going to be restocking in 2010. So this is what's happening. They're building up their stockpiles. They'll be hiring people again. And this means it will be a global recovery. It's not desynchronized. It's not decoupling.
So I get the feeling you're a happy fund manager for 2010.
Well, happier than I was a year ago. I think that's to be
slightly cautious.
I mean, the point, just to make the point, is that policymakers panicked after the Lehman failure. They threw everything at the system. So we've got zero interest rates. We've got the biggest peacetime government spending package worldwide in history, and these things have a long fuse. So recovery's started now. It's taking hold now. We haven't seen the beginning of tightening. So I think 2010 is going to be a strong year.
Great. Trevor, thank you very much indeed. Trevor Greetham there with some very happy words to start 2010. He's from Fidelity International. And that's it for this week, but don't forget to keep up to date with all the latest news and views, and particularly the personal finance pages on Saturday and Sunday. Thank you for watching, and please do join us again next time.